Today, I would like to talk about an incredible situation that has developed in a certain industry in China this year. First, let me show you this article, which is in Chinese. It discusses how 212 private funds have dissolved since the beginning of the year. What's more, this happened right before the Lunar New Year's Eve, which in Japanese terms would be like the 30th of December. So, it feels like many private funds dissolved just before the new year. Perhaps there's a mentality of wanting to end roles and responsibilities before the year changes, to start the new year fresh. However, looking at the details, only one fund dissolved voluntarily, the other 211 were forced to dissolve by the Communist Party authorities. Now, some might wonder, what is a private fund? It's not common for ordinary people to interact with private funds, even in Japan. So, let's explain what they do. Funds collect money from many people to invest. For example, they might invest in stocks, real estate, or foreign currencies. People who have some money but lack the knowledge or time to invest on their own entrust it to investment professionals. These professionals manage the money to grow it, distributing the profits periodically. In Japan, too, more people are entrusting their money to funds. The term private before fund refers to funds where the investors are not ordinary people but those with significant wealth. These funds gather large sums of money, like 10 million yen per share, to invest in real estate or stocks and then distribute the gains. The fund managers also earn fees for operating the fund. Private equity funds are one type we'll talk about. These invest in companies that aren't yet publicly listed but have growth potential. Besides just investing, they might also help these companies prepare for an IPO. If successful, when the company goes public, the stock price can soar, making investors a lot of money. However, if the judgment is off, the investment might not be recovered since you can't sell unlisted stocks easily. There's risk, but the reward can be massive. Also, private funds might invest in startup companies, known as venture capital, or in real estate. In China, there are many such funds, but inherently, they can be quite risky. Someone might collect money promising to grow it, but with no intention of investing, just running away with the money. This isn't uncommon in China. Thus, the general sentiment is that allowing anyone to start a private fund could lead to chaos. However, in China, you can't just start a private fund. There's the Asset Management Association of China, AMAC, which supervises all private funds. Essentially, it's under the guidance of the Communist Party's securities regulatory body. Without their approval, you can't operate a private fund. Returning to the topic, these 211 funds were forcibly dissolved by the supervisory group this year. Why so many? The background is that these funds, despite collecting money from the wealthy, haven't been making profits. Their mission is to grow the money they collect, but many are doing nothing with the money yet still charging management fees, leading to their dissolution. Among the dissolved funds were some with significant state-owned enterprise participation, like Ping An Insurance, a huge entity in China, which also runs private funds but isn't profitable despite the backing of the Communist Party. This situation leads us to look back at the history of private funds in China. An article from 2014 discusses how many of these funds were managed by the offspring of Communist Party elites, known as princelings. For example, Jiang Zemin's grandson ran a very influential fund in Hong Kong. Many such funds had direct or indirect ties to party officials, either managing the funds or being employed by them for connections. This connection was used to grow wealth further, but there was a problem with this wealth being moved overseas, something ordinary people couldn't do due to regulations. When this became too blatant, rules were set to prevent party officials from engaging in business activities, including managing private funds. Now, private fund managers in China need to rely on their professional skills rather than political connections to succeed, which might explain why many funds are struggling with the current economic downturn. Finally, just for fun, I was talking with someone at the golf course about how instead of investing to make more money, one should invest in oneself after a certain age, which doesn't mean just eating well but perhaps personal growth or education. That's all for this video. See you in the next one.